Hello, everyone. We're really excited to be here with you today. My name is Ty Kiesel. I'm the content director here at NAV.
And I'm Jerry Detweiler, Education Director at NAV.
Today, we're going to talk about how to decide what type of business loan you need. You know, years ago, there was basically one place you would go. You'd go to the bank. And now I'm convinced that there are more options available than ever before, but you need to know where to look and what type of financing is going to best suit your particular business need, because financing now is a little more specialized than it was before. So we're going to kind of dive into that today. We're going to talk about maybe some of your goals for the financing, or what I like to refer to as your loan purpose. We're going to help you evaluate your qualifications. We're going to talk about some of the financing types that are available, as well as some resources that'll help you with the whole financing process and some of next steps. So this should be a really interesting conversation, and hopefully it'll provide a lot of value to you at the end of the day, so that you know what type of financing you should be looking for, so you're not wasting your time with financing that isn't going to help you out. Jerry, do you want to kick us off with a goals discussion?
Sure. So you really need to think first about what your goals are in getting financing. And I know that for a lot of small business owners, just the idea of having money available, it seems like the goal in and of itself. But you're really best off when you have a specific goal in mind for the financing that you plan to obtain. And it can be something like working capital, which is just money available to cover daily expenses, for example, when cash flow is slow. And many business owners, Ty and I both have been business owners ourselves in the past. We've both experienced this. Many of them will experience fluctuations in revenues, unexpected expenses, as well as times when clients pay slow, etc. And so just having that money available when you need it is a goal in and of itself. But then you may have also very specific goals, such as purchasing inventory, getting new equipment, hiring some employees. You may land a big contract that requires you to hire some new employees, but the revenues don't come in as quickly as the expense of that additional payroll goes out. Or maybe you want to open a new location for your business, a secondary location, or relocate your business. Or if you're like some businesses today, you want to consolidate debt. You see that interest rates are lower, lenders are starting to lend again, and you want to consolidate to get a lower payment or lower interest rate. All of those can be very valid reasons for financing, but knowing what your goals are will help you pick the right type of financing.
You know, this is at the very top of the list, because the reason you're borrowing will help you determine how much to be seeking, as well as where to look. So always ask, what am I borrowing for? What am I trying to achieve? Because it's the first question you should ask yourself. And then you need to kind of look at your qualifications. What are your annual and monthly revenues? What are you depositing in your bank account over the last 6 months? What are your revenue trends? When I was a small business owner, I wasn't in what I would necessarily classify as a seasonal business, but there were ebbs and flows to how income came in. Some months were fatter than other months. And so you kind of need to be looking at that. You also need to look at your deposits. How many and from how many sources are they coming? For example, if you only have 2 or 3 deposits from 1 or 2 customers a month, that's going to be a red flag to a lot of small business lenders, because they want to see multiple sources of deposits, and some types of financing are going to require deposits throughout the month rather than at the end of the month. Sometimes they call that lumpy financing, when it all comes at one point, because that will make some of the financing we're going to talk about today a little more problematic for you. Also, you want to look at the number of low balance days you have. One of the things that Jerry and I recommend is, if you can, put aside a little bit of extra money in your bank account that you don't touch. maybe when you show a zero balance, you have still $500 or $1,000 in the account, because that way you're not going to have non-sufficient funds crop up on a regular basis, which is another red flag for a lot of lenders. So depending upon your financial situation and how you handle low balance days and NSF days, that could be a problem for a lot of lenders. And you also want to ask yourself, do I do a lot of B2B invoices? Do I have a big accounts receivable? Because you can leverage that for financing. And the last question is going to be, do you have collateral? Some types of financing are going to require collateral. For instance, if you go into the bank or the SBA, they're going to require something as collateral. Now, not all lenders do, so that's, that isn't a necessarily saying that you're not going to be able to get a loan, but these are questions you need to ask yourself. And, one of the things that I've noticed over the years is that there are a lot of businesses that just will not even consider your loan application unless you have a business bank account. So that's something that every small business needs.
Yes, I like to think of it almost like another credit report for your business. Your business bank account is another outside factor that lenders may take into account, and many lenders do want to see business bank accounts. So, so it really is crucial to getting many types of financing. Time in business is also important. And here, once you have at least 2 years in business, your options are going to increase. There are a number of lenders that would like to see a minimum of 2 years in business. Some have increased that time to as much as 3 years in business post-pandemic, but we are seeing them starting to ease back. So some of the lenders that went from 2 years in business required to 3 years are now starting to go back to the 2 years required. We'll see how that plays out with the ups and downs of what's going on with the pandemic problem. But generally speaking, being in business longer just makes your business automatically less risk because you've survived those first couple of years. Now, that doesn't mean you won't have any options, but startup financing options are fewer. And so we do want to be realistic in that. And then later in the presentation, we'll point you to some options if you have a startup business.
Now, your credit scores are really important. And I've been on enough panels where they've said, well, your business credit profile doesn't matter. All that matters is your personal credit. And other people have said your business credit is what's most important and your personal credit doesn't matter. Well, the fact of the matter is that your personal credit and your business credit work together. There's a synergy there that help you get the financing that you need. For a lot of lenders, your personal credit score is going to be kind of a go-no metric for them to determine whether they want to work with you at all. And this is going to apply to every owner in your business with greater than 20 or 25% ownership. And every point above 650 is better. That doesn't mean that if your personal credit score is below 650, you can't get financing. There are options available. However, the weaker your credit profile, the more expensive and the less favorable some of those loan terms are going to be. And, revenue-based financing is probably the most flexible because it's based less on your credit score and more on the amount of revenue you have coming into your business, but it's also more expensive. We'll talk about some of those options in a minute. Your business credit, some lenders may use your business credit and your business credit profile to help them determine your credit worthiness. And most lenders will use it to check for red flags. They want to know how you're paying your bills, how you pay your vendors, how you pay, maybe you have a business credit card. Are you paying that on time? Now, FICO introduced the SBSS score that the SBA uses, which is kind of a hybrid or a combination of your personal credit and your business credit. And they kind of weigh both in a more formalized way than a lot of other lenders. But just recognize that if you are a small business owner and you're listening to us today, it's probably likely that your personal credit will be a part of the equation as well as your business credit.
And then another factor matters. So far we've talked about how your revenues matter, how your time in business matter, and how your credit scores matter. And I think those are the key pillars. But the other one that could change your loan options is your industry. So some lenders prefer to lend into certain industries. Some will have restricted industry lists where they will not lend into certain industries. And oftentimes you can find this on the lender's website. So that's an option for you to just evaluate. Now, they usually use something called the SIC or SIC or NAICS code. These are codes that were originally developed by the government to track businesses for statistical purposes, but they're now sometimes used by on credit reports and by lenders to identify the industry that the business is in. And so they're very similar. SIC codes are the older version, NAICS codes are the newer version, but they're similar types of codes. And if you check your business credit, which you can do for free at NAV, you may see this on your business credit. And then in turn, lenders may choose to market to businesses within or restrict against businesses within certain industries. So make sure that's accurate. I'll give you a quick example. At NAV, we had a customer who manufactured signs that would go in the real estate agents would put in the yards of the houses they were selling. And he was having trouble getting financing. He discovered that his NAICS code indicated he was a real estate broker. And in fact, he was a sign manufacturer. So he got that fixed and changed. And then different financing options became available for him as a manufacturer versus, as in the real estate brokering business. So just make sure yours is accurate. You may not find one that perfectly describes your business. That's fine. Just get as close as you can. And then keep that information updated correctly, especially if you change your business focus.
Yeah, if you were to look at your Dun & Bradstreet credit report, for example, it's going to compare your business to other businesses in your industry. It's going to compare your business to other businesses of your size, and it's going to compare your business to other businesses with the same number of employees, the same types of annual revenues. And you could have a really great business, but if you're in the wrong industry, it could definitely hurt you. And now what you want to do is you want to match your financing goals to the financing types available. I like to compare this. This is definitely an oversimplification, but I compare this to buying a home and buying an automobile. Most people I know would never buy a new car with a 30-year auto loan. In the same way that most people would never be able to afford a new home with a 3 or 4 year auto loan. You want to make
Mortgage, 3 or 4 year mortgage, yes.
yeah, 3-year mortgage. And you just want to make sure that the financing type you're looking for is going to match the need you're trying to fill. For instance, working capital loans, we typically are considering shorter term loans, lines of credit, invoice financing, trade credit, business credit cards, because you can get in and out of the financing relatively easy. For example, purchasing quick turnaround inventory that you're going to sell over the next 3 or 4 months it may not be best suited for a 10-year term loan. You may want to look at something that's a little shorter term, maybe 6 months, maybe a year. It kind of depends. You want to match the type of financing you're getting to the business need. Now that's completely different from financing designed to scale and grow your business, like purchasing equipment, a long-term loan or SBA loan that's going to be buying things that have a value that extends beyond 3 or 4 months. There are also a number of microloans that are good for this. Trade credit is also good for this too. And then if you have, over the course of the last, I think it's been 10 or 12 years, there have been a lot of short-term financing it's revenues-based financing with daily or weekly repayment terms. we have options. There are options available to us now for consolidating some of that short-term debt into a longer-term repayment period, commercial mortgage refinance, accounts receivable financing, equipment financing. These are all different types of financing that are specifically intended for different use cases. And there is no, maybe in days past there was a one size fits all loan at the local bank, but that doesn't really exist anymore. So you kind of want to have a handle on the types of financing that are available to meet your particular loan needs. I like to say that you don't need to be a financing expert in order to find the right type of financing for your business, but you do need to be a little more savvy and understand what options are available and how they might meet your specific needs.
Yeah, so let's talk about the two probably most popular types of financing that business owners are generally familiar with, and that's lines of credit and term loans. These are often available through banks, but also may be available through online lenders as well. And in the case of banks, they may be available as a bank line of credit or bank loan, or it may be available through the bank, but it's guaranteed by the SBA. That would be called an SBA loan. So the line of credit, that's where it's like a credit card. Basically, you get an amount that you can borrow against as you need it. And the beauty there is you only pay interest on the amount you borrowed. As you pay it back, you can borrow again. Some lines of credit are interest only. Some of them will have a period where you can borrow and then a draw period, and then they'll have a repayment period where you cannot borrow anymore. You have to pay back the outstanding balance. So make sure you understand that if you go for a line of credit. Term loans are typically fixed amount of money for a fixed period of time. It can be short term. It can be a 18-month, 2-year, or 36-month term loan, or in the case of some bank loans and SBA guaranteed loans, it could be as long as 20 or 25 years that you have to borrow that money. And that would probably be for a very large expense like equipment, real estate, something like expansion, something like that. So it's more predictable. You know how much you're going to pay. Great for specific projects. And the interest rate may be variable, but usually the payment is pretty steady. It might change slightly due to changes in the interest rate, but it's usually a pretty steady, predictable payment. So remember we had that slide about the types of borrowing you might do. You think about, okay, is this a short term, like Ty said, is this short term, like a car loan? Or is this long-term like a mortgage? And that will help you decide between these two, because lines of credit are generally short-term financing, a little bit higher interest rate. Term loans are typically longer term with a lower interest rate. Again, the exact terms vary depending on the lender. So for the requirements, they're going to be all over the place. It depends on where you go. If you go to the bank, it's going to be very, probably quite stringent requirements. You're going to probably need 2 years in business. You're going to have minimum revenues that your business has to meet. It has to document through a business bank account. You may have to produce business tax returns. You probably will have to show a personal financial statement at a bank. And then the credit requirements will often be that there will be a personal credit check on any owner with 20% or more ownership. That varies, but at least 20% ownership. Typically, there's a credit check. And then there may be a business credit check, and the minimum credit score may vary. So if you're looking online for a line of credit or term loan, it's going to be more flexible, probably shorter term, a little bit higher cost, lower credit score requirements. Go into the bank, it's probably going to be more stringent, but excellent, very low interest rates. So that just depends on what your qualifications are in terms of what you will be able to qualify for.
Well, I skipped one, sorry. SBA loans are another great option. And Jerry probably knows more about SBA loans than I do, so I'm going to let her share her thoughts on SBA financing.
Sure. So we've written extensively about SBA loans on the NAV blog, and we have this free e-guide that talks about the different SBA loans. There's a whole alphabet soup with it, so don't get too confused or too overwhelmed because your lender will help you determine what's right for you. The flagship program is called the 7A program. And then another popular program is the SBA Microloan program, which is small loans, usually averaging about $15,000. And then you have something called the 504 loan, which is excellent for businesses that need to expand, purchase real estate that they'll own or occupy at least 51%, or purchase heavy equipment. And any of these loans, they are going to require good credit. There's no, for the most part, the SBA doesn't set a credit score requirement, except for certain loans that require a FICO SBSS score. But they do require good credit, and they're also supposed to be available to business owners who can't get similar financing elsewhere. That's the credit elsewhere test. Don't worry about that too much. Your lender's going to take care of that. But here's the one thing I want you to know about SBA loans. You're going to go to a lender. So if any of you got PPP loans this past year due to the pandemic, you went to a lender to get that PPP loan. Even though the loan was guaranteed by the SBA, you didn't go to the SBA. You went to the lender for that. Same thing with SBA guaranteed loans. Now, the lender has to follow the SBA requirements so that if you default, they can collect on the guarantee from the government. However, they can have their own requirements on top of the government requirements as long as they don't discriminate on a prohibited basis. So some lenders may prefer to lend again into certain industries and not into others. Some may have a little bit higher credit score requirement than another. So what that means is, just if you talk to your bank and you didn't qualify for an SBA loan, find out if it's because of an SBA requirement or their requirement, and consider looking at another SBA lender. So just because one SBA lender can't give you a loan doesn't necessarily mean another SBA lender can't. And that's one of the things we do at NAV, is help match borrowers to SBA loan options.
Vendor terms, trade lines, payment terms, whatever you call them, this is probably one of the most misunderstood and underutilized form of credit available to small businesses. I love this as a great way to free up cash flow for things that you can't finance. In most industries, suppliers will offer you net 30, net 45 days. It's a low cost, often zero interest, as long as you pay within the payment terms. And sometimes if you pay early, you even get a discount. And I know of a lot of businesses that over the years have used that early payment discount to help them pay for things like their payroll. I mean, it's a great way to have access to cash. Granted, it is not a small business loan, but it is financing that's available to you that will help you build a strong credit profile and free up money that would have otherwise gone to pay COD for the supplies or the inventory you buy, and allow you to pay it in over time, over 30, 45 days, whatever those terms are. A good personal credit score is not required. They will maybe look at your history with businesses, but as a general rule, you should expect that your vendors are going to be interested in doing this with you, because it makes it easier for them as well. And I think you'll find that these are some of the best, most friendly creditors you will ever have. A lot of these suppliers that you probably are using now are startup friendly. So if you've been in business for a couple of months, you can still do this. And like I said before, it can help you build business credit. If you work in an industry that does not have this type of relationship with your suppliers, if you go to vendors, nav.com/vendors, there are a list of vendors there who they offer the general supplies that businesses use all across the country, regardless of the industry you're in, and it will help you establish those type of accounts with with vendors that report to the business credit bureaus, and your good credit practices will help you build a credit profile, particularly if you're a younger business. A few years ago, after the economic crisis in 2008, I was talking to some folks at one of the business credit bureaus about customers they had been tracking over the last 2 years. So this would have been about 2010. And they said, of the businesses that were doing really well in 2010, the majority of them had two things in common. Number one, they leveraged vendor terms to build their credit profile and to build their business. And the second one was they used business credit cards, which we'll talk about later.
Yeah, and I should mention real quick, we have a very popular presentation on Tradelines. So if that intrigues you, the idea of using these accounts to build business credit, increase cash flow, and maybe work on your business credit while you're still working on your personal credit, make sure you check that out as well. So microloans, I love microloans for businesses that need a smaller amount of money. And generally you'll find these loans are typically $50,000 or less. They can be as small as $500 for a startup business that really needs some money to get off the ground. They are often offered through nonprofit organizations. So places like community development financial institutions, which are typically nonprofits that are tasked with lending money to help underserved entrepreneurs. So it might be women-owned business, minority-owned businesses, veteran-owned businesses, et cetera, or rural-owned businesses, wide categories of businesses that may otherwise have trouble getting capital. And so these programs typically are more credit flexible. If you have a good explanation, for example, of why your personal credit was damaged and you're recovering, they may be able to help you. They provide technical assistance, in other words, consulting or mentoring or education to help your business be successful, etc. Now, these can be hard to find because they're nonprofits and they're often very geographically local. And so they're not necessarily out there advertising or telemarketing or reaching out there like some of the big for-profit lenders would be. So a few tips for you. One is you can look at CDFIs. We have an article on the NAV blog. So if you go to the nav.com/blog and just type in CDFI, you'll see an article, and that actually links to a list of all the CDFIs around the country. So you can do a little bit of research to see which ones are in your local area. Your SBA resource partner like SCORE or a small business development center, both of which help entrepreneurs for free. They can often refer you to local microloan programs as well, or local CDFIs. The SBA has a microloan program. And as I mentioned earlier, the average loan amount there is about $15,000. Another organization you may want to check out is Kiva, KIVA.org. Kiva makes 0% zero fee loans to small businesses in the US up to $15,000. They also have an international program, but the limits are different. And it's a wonderful organization. They're there to support entrepreneurs. It's basically you get a few people to back your initial campaign by contributing, say, $25, and then they open it up to the platform and they help fund these loans that you need to repay, but you won't pay any interest or fees. So can't get any better than that in terms of the terms. And then Axion, which is also in various communities across the country. They're a nonprofit and they have a variety of lending programs as well. So again, you will have to do a little bit more research. We do have some of these microlender partners in the NAV marketplace, but you may also need to do a little bit extra research if this is of interest to you. But if you need a small amount of money or you're a startup and you're having trouble finding other financing, this may be an option to consider.
One of the reasons why I'm a fan of microloans, and I think Jerry agrees with this as well, is if you can leverage a small amount of money to a big impact, this is a great way to go. We recently did when we were involved in the PPP, we looked at the average loan size, and it was below $15,000 for millions of dollars worth of small business loans that we were involved in. And so that's a great example of businesses leveraging a relatively small amount of money to big impact. And, like Jerry, I'm a big fan of Kiva. Years ago, I was talking to one of the executives there, and he told me about an artisan cheese manufacturer in Arkansas that was making cheese out of the basement of his local church. And he was building his business, and he got to the point where he needed a new cheese vat in order to expand. And he got a $5,000 loan from Kiva, and now years later is the biggest independent cheese manufacturer in Arkansas. So microloans are typically smaller amounts, but boy, they can have a huge impact. Equipment loans and leases. This is another great type of financing for a number of reasons. It may be available to younger businesses because they're going to leverage the equipment that you're purchasing as collateral on the loan. So it's a lot less risky loan than other types of financing. It's also a little more flexible with credit scores. There's possibly tax advantages. You're going to want to talk to your tax professionals about it. It may require a down payment, but that's not bad too. But another reason that I like equipment financing is because you can leverage the cash that's in your business for things you can't borrow, and can use equipment financing to borrow for the things that you need. Maybe it's a pizza oven in your restaurant, or the desks and chairs in your office. There's lots of things that qualify for equipment.
And then business credit cards. Ty and I both are a big fan of business credit cards because they are pretty easy for any business with a decent, where the business owner has a decent personal credit score to be able to qualify. So that includes startups. In fact, you could start your business today and apply for many business credit cards tomorrow. It's that quick of a decision. So it's based on your personal credit score and income from all sources, not just the business in most cases, not all, but most cases. Now, a couple things to keep in mind. Some of these cards do report all information to the owner's personal credit. So just be careful. If you have a lot of balance, if you're carrying high balances on your business credit card, that could spill over on your personal credit report, depending on the card you're using. We have a list at nav.com/reports of the major issuers' policies. And then at nav.com/business-reports, we have a list of the issuers and how they impact your business credit. So most of these cards do report to business credit bureaus as well. They offer a flexible line of credit, just like we talked about earlier, and you can earn significant rewards. We've just published a new article at NAV about the top welcome offers available on credit cards right now. Issuers are lending again post-pandemic, and there's some really attractive rewards out there for business owners. So make sure you check out business credit cards as an option.
I'm a big fan of business credit cards. Another type of financing is invoice factoring or accounts receivable financing. Basically, this leverages what you have in your accounts receivable either as collateral for a loan, or you can sell your invoices to a factor and at a discount, of course, and they'll collect the amount from you. So this is a great way to access short-term financing. Now, it may be a little more expensive than a term loan, but it's a great way to access capital quickly.
Commercial mortgage loans. So these are if you want to get property for your business, either a location that you will be in or a location that you want to rent out. There's a lot of different commercial mortgage loan programs out there, but we have seen an uptick at NAV in business owners successfully obtaining property that way. So just make sure that you check that out as an option. And another thing to keep in mind is there is the SBA 504 loan program. So if you are going to purchase property or expand your current property and you will own or occupy at least 51%, it's a little bit higher if it's brand new construction, the owner occupancy requirement, then you may want to look into the 504 program too, because that offers very attractive terms. So right now rates are really good on these types of loans.
one of the things we do at NAV is we match your qualifications to appropriate financing. So we'll take a look at your credit profile, the revenues that your business has, and the time in business, and match you to the financing that makes sense. So you don't have to waste time looking for financing in places where you are less likely to qualify. And then we can help you improve your situation for next time to get even better financing.
So let's just quick summarize some of the types of financing we talked about and where they might be appropriate for special situations. So, for example, if you're a startup, some options you may want to look into: business credit cards, equipment leasing, vendor accounts or supplier accounts, microloans, and crowdfunding. We didn't talk much about crowdfunding, although we mentioned Kiva, but that could be an excellent option for a startup as well. Now, if you have low credit scores, then you're going to need some financing that isn't dependent on your personal credit score. That could be merchant cash advances, some equipment leasing and financing options, vendor accounts that don't check personal credit. Remember, we mentioned that, nav.com/vendors. Those don't check personal credit, and microloans that might be more flexible. And then if your business has low revenues, but let's say you do have more time in business or you have good credit scores or other qualifications, you might be eligible for vendor accounts, microloans, or business credit cards, as well as there are some term loans that might be available depending on your revenues if your personal credit scores are very strong. So again, what you're trying to do is what Ty just summarized, which is match the type of financing to your qualifications. And if you were to try to do that on your own, you will get frustrated very quickly because not all lenders publish these requirements. They don't always say, some do. Some may say require a year in business and this credit score, or we require 2 years in business and this amount of revenues, but they don't usually publish all their criteria. So that's where it's helpful to use a marketplace like NAV to figure out what financing may be available to you based on your qualifications.
Just be aware that there is a correlation between how easy it is to qualify and how expensive or inexpensive the financing may be. The better qualified borrowers are going to get the best interest rates and the most friendly terms, where the least qualified borrowers will probably end up paying more in interest. So let's talk about some of the resources that are available at NAV for you to help you navigate through this process. And NAV can help you get matched to the financing as your business grows. There are free and paid accounts to help you check, monitor, and build your business credit. We tend to impact the things we pay attention to the most. And so monitoring your personal and business credit is just a good idea. And I'll be honest with you, monthly is not too frequently if you want to impact those numbers for the better.
Yeah, and I do want to mention, Ty, that for those who are watching, some you may be thinking, I don't really need financing right now. I'm going to worry about this in a year or down the line. But really, right now is such it's a tumultuous time, but there's also a lot of opportunity. So there are a lot, we already knew even before the pandemic, we knew that there were a lot of older business owners who were going to try to sell their business. And just like their kids don't want their stuff, their kids don't want their business. So they're going to be looking for someone to purchase their business or to purchase the assets of their business. And that means this could be an opportunity for you where that the pandemic has kind of accelerated that, where they're like, you know what, I'm done. I'm going to get out of my business and I'm going to sell my assets or my business or all of it. And that could provide great opportunities for you to expand your business by taking advantage of that. The marketplace Biz Buy Sell, which is for business owners who want to sell and business owners who want to buy, is reporting they're having record activity on that site. So what does that mean? That means that even if you're kind of a bootstrapper, you don't like debt, you don't like to borrow, you still may want to be lining up financing to take advantage of those opportunities because those things tend to happen quickly. You see that that particular piece of equipment for your business at a fire sale, you want to be able to snap it up and have the financing in place so that you can purchase it. You see that business that could double your business because it could take out a competitor or could increase your customer base. You want to be able to take advantage of that quickly. I'll give you a real life example real quick. And I was on a webinar with accountants, and one of the accountants reached out to me after, and she said, I have this side business where I sell jewelry on eBay. And I think it was Pandora jewelry, if I recall correctly. And she said, this jeweler in town's going out of business and I can buy his entire inventory, but I need to get a hold of several hundred thousands of dollars quickly so that I can acquire this inventory. And she, she's a number person. She knew how much she could make by selling this jewelry, by buying it at this going out of business price and then reselling it on eBay. So that's the kind of thing that you want to be aware of. So the short answer to my long diatribe there is, don't wait until it's an emergency. Look at a minimum, lining up that line of credit so that if something happens, cash flow, opportunity, or crisis, you have the financing in place.
NAV's match factor is a great thing to take advantage of. If you apply for a business credit card through NAV, you're 3.5 times more likely to be approved. Now, that doesn't guarantee that you're going to get the credit card you're looking for, but I would take those odds any day. 3.5 times more likely to be approved for a credit card through Match Factor. This is a great way to access business credit through a business credit card.
Yeah. And by the way, we don't sell your information to lenders to market to you. So you're not going to get a bunch of, you'll get emails from us, and you may even get a call from us, seeing if we can help you. But you're not going to get bombarded with calls from lenders just because you've signed up for NAV. So you sign up for NAV, you go in there, you see your matches, and you're in control of determining the next step that you want to take in your financing journey.
Well, get started. Review your business financing profile for free at NAV. Doesn't cost you anything, and it'll give you a great idea as to what you might qualify for and where to go, what the next steps might be. Look at what your options are currently and see what matches you have. It doesn't cost you anything. Weigh those options, make sure they make sense for your business, and if they do, go forward and get the financing that you're looking for, because you can monitor your financing profile while you're working on your qualifications, so you can get better financing maybe even next time. But the time to get financing, if you're ready, is right now, and you can jump in and get started with NAV. We sure appreciate your attendance here at this webinar. I hope that this information was valuable and that you've learned something to help you along the journey to growing your small business. If you have any questions, please reach out to us. We'd love to answer them for you. And in the meantime, good luck.
Thanks, everyone.